Hey guys, how are you? This is Eric Bramlett with Bramlett Residential, and today we are here to discuss the July 2024 Austin Metro real estate market statistics. This month was a bit of a surprise, only that the numbers didn't come in a little bit worse than they came in. I expected contracts to be down pretty considerably, and that wasn't the case. They were down on a year-over-year basis and on a month-over-month basis, but that was to be expected, and I expected the numbers to be honestly quite a bit worse than they actually were. So let's get to it. We're gonna go straight over to the numbers here. And these are the main statistics. So total sales in the metro declined only by 1.3% year over year, and pending units declined by only 9.2%. We expected that to be quite a bit worse than that because it's an election year and because we haven't seen a lot of negative movement on mortgage rates. And by negative, I mean positive. We want them to be lower. Active listings up as expected, up 22%. Withdrawn listings up 14%. This is the good news, pretty good news here. Average and median sold price both dropped very marginally at minus 3.1% on average and minus 2.4% on median. Average sold price per square foot and median sold price per square foot were very similar as well. Months of inventory increased by 34%. We are firmly in a balanced market at 4.7 MOI, but it feels much more sluggish than that. Whenever you are out in the field working, buyers have a lot of leverage and sellers are really, really happy to see offers. I'm going to jump straight into the pending units by month. If I had to pick one chart to summarize 2024, this would be it. And when you look here, you can see that we started the year off really nicely. It looked like we were going to have the recovery market this year. And then in March, April, that's when it crossed over and it dropped pretty precipitously. In May, that's whenever we said, oh, wow, this year is going to be quite a bit worse than 2023. So this is a pretty good leading indicator of demand. This shows you the number of contracts the number of properties are going under contract. And you can see that we have been in a decline versus 2023 since the month of April. Volume sold tells a very similar story. So volume sold is literally the dollars that are transacting. And you can see that we had a decline of 4.4% year over year for the month of July. And we finally turned negative on a YTD basis. Closings lag behind pending units. So it's not a surprise that it took until we were in the month of, I think June is whenever we crossed over. And now in July, you can see that we're just under a 2% drop versus 2023 in total volume sold in the Austin Metro. New listings, similar story. The year started out with optimistic sellers coming on the market. And then you can see in June that changed, and that is basically staying the same. New listings coming on the market are now relatively on par with 2023 and a little bit lower. So these are sellers that are just saying like, hey, this is probably not our year. Whereas earlier in the year, people were optimistic and they were coming on the market because it looked like we were going into a recovery year. Average and median sold price, you can see here that it's almost completely flat on a 12-month rolling basis. And then if you look at median sold price on a seasonal basis, you can see that we're following a similar trend, which means that prices will decline between now and the end of the year. And you can see that we're just a little bit lower than we were in 2020, 2023. Similar story with withdrawn and expired listings. We are up versus 2023 whenever you look at this. And this is also seasonal right here. You can expect for more sellers to just drop out between now and next spring, and the next spring is whenever the market will reset. So why? Why is this all happening? And mortgage rates are talked about a lot. We did see mortgage rates drop pretty recently. In the last couple of weeks, we've had some good news from the Fed that it looks like they will start easing relatively soon. We're down from around 7% to around 6.5%. And that's a good thing. And we have felt a very small uptick because of that. But what doesn't get talked about as much as mortgage rates is the job market. And we look at Indeed.com data because it's readily available. Indeed has something like 1/3 of the market share of all job postings in the United States. And tech jobs specifically show up on Indeed. And this is 12-month rolling Indeed.com job postings. It actually looks like I've got the June numbers here, but July shows the exact same thing. And I will move over here. This does show you to July. This shows you what the Indeed.com job postings look like from January 2020 to present. And you can see that due to stimulus, due to a pretty loose monetary policy between 2021 and the first part of 2022, employers just hired anybody they possibly could. And I've heard it summarized as there was a lot of hiring done during the pandemic that hasn't been digested yet. What we saw was first major employers, tech guys, issued RTO, return to office, and they said, look, if you don't come back to the office, you're quitting, basically. They were able to shed a lot of their workforce by doing that. They are not hiring, basically. If you see the postings that are out there are generally there to replace existing staff. And we're just seeing the first rumblings of layoffs. So, Dell announced recently that they're going to do a pretty big round of layoffs. Intel, same story. Indeed themselves, it was about a year ago. I think they cut something like 14% of their force. So whenever you see the literal jobs company laying off, it's not a very good indication for the job market. Now, we do expect that to change. We do expect that to turn around. They're affected by the Fed rate just like mortgage rates are. There will be a bit of a lag on that, though. We expect whenever the Fed starts lowering rates pretty soon, we're going to see mortgage rates drop almost identically with that. I don't know how long it will take for jobs to recover once the Fed rate starts coming down. But that's the second half of what we need to see to get back into a recovery. All that to say, you can still sell houses in this market. It requires some really sound strategy. If you're a buyer and it makes sense for you to buy right now, this is going to be viewed as a buying opportunity in retrospect. If I had to guess, Q3, Q4, 2024, maybe the very beginning, the winter of 2025, that will probably be the low point of this downturn. No guarantees, obviously, but I do think that if you are interested in buying and you will be in the house for at least 5 years, that's always the qualifier. It's a good decision. And the average homeowner in Austin stays in their house for 8 years, and it is literally impossible to find any 8-year period since we've tracked numbers where it wasn't a smart decision to buy. So if you're stable, you got a good job, it makes sense for you, look into it. It's a good decision. You'll probably be pretty happy with yourself a few years from now. I'm Eric Bramlett. Follow us on here. If we can help you with anything at all, reach out. I'm dropping a link to an Austin real estate statistics group that I run in the description here as well. So please join that if this stuff interests you. And if I can help anybody at all, any homeowners, any buyers, any agents, please reach out to me. I would love to help you guys. Thanks so much. Have a great weekend. Bye.